Ladies and gentlemen, good day and welcome to the Mahindra Logistics Limited Q3FY22 Earnings Conference call. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shogun Jain from Strategic Growth Advisors. Thank you, and over to you, sir.
Thank you, Tanvi. Good evening, everyone, and thank you for joining us on the Mahindra Logistics Limited Q3 FY22 Earnings Conference call. We have with us Mr. Ram Praveen Swaminathan, Managing Director and CEO, and Mr. Yogesh Patel, CFO of the company. I hope everyone got an opportunity to go through our financial results and investor presentation uploaded on company's website and stock exchange. We will begin the call with opening remarks from the management, following which we will have the forum open for a Q&A session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I now invite Ram, Managing Director and CEO of Mahindra Logistics Limited, to give his opening remarks. Thank you, and over to you, sir.
Thank you, Shogun, and good evening, everyone. I hope you and your loved ones and colleagues are doing well and safe as we're in the midst of Wave 3. I do hope you all have had a chance to review our results and presentations, which are available on the stock exchanges and our own company's website. Today, I will provide a quick overview of the external environment in the quarter gone by in terms of our end markets and overall developments in the logistics industry. We'll follow that with a commentary on our performance, and our financials. Given some of the margin challenges we had, we'll dwell a little bit more on that, and then we'll also cover a broad update on strategy and some key initiatives across the company. So let me begin just with the external environment. Overall demand for logistics services and solutions continues to see an improving environment and momentum as companies focus on responding to supply and demand volatility with a higher focus on resilience. We continue to see a strong shift towards multimodal movement, especially both coastal shipping and rail shipping in commodities and the automotive sector. The drive towards network expansion and omni-channel fulfillment is resulting in greater traction in fulfillment logistics, last mile delivery, and an increased demand for integrated solutions. Global supply chains remain pretty fragile, with shortages in containers, shortages in sea movement, ocean movement, and air movement, as we all see some impact of geopolitical factors, both in terms of demand and otherwise. These factors have created a lot of pressure on our customers' operations as we try to manage a globally disaggregated supply chain in most industries. In these conditions, technology remains a key lever for driving increased efficiency and customer experience across the value chain. Now, looking at our specific markets and how they are performing, let me begin with automotive. As we saw in the quarter ending September 21, the semiconductor chip shortage continues to endure, and a structural improvement is likely to take place only in a few quarters from now. Several factors like OEM price hikes, high fuel prices have added to the issues of chip shortages, and demand has been subdued. During the quarter, while there was a strong growth in CV sales, these have in some cases been driven from inventory. Demand for domestic two-wheelers also remains subdued. Our business in auto, both M&M and non-M&M, was impacted by the slowdown, given lower volumes compared to last year. The volatility in volumes also had some impact on gain-sharing programs we have with our customers. From an outlook perspective, we expect to continue to see volatility here, with improvements coming through only in the latter half of the next financial year. Moving on to farm and agro, the tractor and ag market has seen a slowdown in the last quarter, and there continues to be an overhang. Due to significant base effects and unseasonal rains, the domestic tractor sector has had a year-over-year decline. This was true for us also, with a volume drop, more precipitated in outbound movement due to lower sales, while our customers continue to manufacture tractors, given the upcoming season. E-commerce, which is the last quarter marked the most important seasonal peak for the e-commerce segment. Overall, festive demand was fairly moderate, and the impact was more pronounced for specific categories like electronics and large appliances. While October showed positive traction, November was marginal and December was pretty muted, owing to off-season sales for ACs, fans, and air coolers. While some categories like dishwashers, laptops, and microwaves continue to witness steady growth, the high base of last year is catching up in those categories as well. Metros and Tier 1 cities saw good demand in the peak, while rural demand was more subdued compared to last year. Multiple factors seem to have contributed to kind of a moderation of demand, including reopening of physical distribution systems and stores, wave 2 impact on consumer sentiment, and larger supply chain issues on large electronics due to the semiconductor problems and the whiplash which that has caused across the world. Moving on to consumer pharma, FMCG, and electronic durables, and so on. We saw positive momentum here. In addition, to as I said earlier on, there was an opening up of markets which I think has helped. That said, in addition to high base, rural demand was affected by inflation in Q3/22. Rising prices on farm inputs have been greater than those on output, having some effect on farmer earnings. We have seen growth in modern trade and e-commerce in these markets. Discretionary categories also saw significant growth, aided by improved mobility, increased footfall on premises, a larger number of social events, and of course, a seasonal uptick in wedding demand. Our own volume showed moderate growth here, driven by these factors, with more volumes really coming in the first mile and the mid mile. This was also the first full quarter of the Bajaj project in steady state form. And despite these external factors, we saw a strong revenue growth flow through coming on account of Bajaj in addition to the rest of our accounts. Moving on to enterprise mobility, due to the continuation of work from home policies and additional restrictions imposed by state governments, the enterprise mobility segment, especially the BFSI based customers, that they remain pretty subdued in terms of demand. We have been able to repivot demand towards other segments like e-commerce, and other managed services markets. We expect enterprise mobility to remain under pressure, but we made a conscious effort, as I said, to broaden the customer portfolio, and that has shown good traction in the quarter gone by. Lastly, let me comment a bit on international freight forwarding, or our freight forwarding subsidiary. Global supply chains remain pretty overheated, as I mentioned earlier, with shortages of containers and liner capacity issues. Due to these factors, there is shortage-led inflation in pricing across the board in air and ocean products. The recovery in exports is aiding a broader growth pattern with an uptick across all categories. Imports pressure remained due to the global supply chain issues, which we talked about earlier. Overall, the segment is benefiting from a positive pricing environment, though margins do remain under pressure. We continue to show strong growth here, and our focus here remains to diversify our offering base and balance the right trade lanes and work with the right enterprise customers. Now, moving on to the operational end of the business, despite some of the challenges from a demand perspective, we continue to see positive traction from a revenue perspective in almost all our segments. The auto business was, of course, impacted along with the farm segment. Given the broader macros there has been a resultant drop in revenue from customers, including M&M. In e-commerce, consumer, freight forwarding, all these segments had strong revenue growth. We continue to obviously continue to demonstrate quarter-on-quarter traction in these segments. Overall revenue in these segments grew by 24% on the SCM side, across the board, and we did have an unfavorable impact on the non-M&M auto piece, as I mentioned earlier. Our warehousing and solutions revenue grew by upwards of 37%, driven by continued focus in this space, despite some of the demand challenges we spoke about. We have won several new accounts during the quarter, including a large distribution fulfillment operation for a big FMCG company in Western India, distribution fulfillment in Eastern India for a leading garment manufacturer, inbound to manufacturing and distribution for an EV two-wheeler OEM. And we are expanding in the retail space with a multi-brand, with one of India's largest multi-brand retail chains. These projects will go live in the coming months and continue to underline us.
Hi, good evening. This is Sumit Kishore from Axis. Thanks for the opportunity. My first question is, warehousing and solutions business grew almost 35% year on year. Even the non-auto business saw 24% growth. Just want to understand, how should we look at the scope for operating leverage-led margin improvement in your business model? And on a relative basis, would the margin pressures have been higher in, say, transportation, which saw a slight dip, and in the auto business, which saw a 6% decline?
Yeah. Sumit, do you just have one question? If you have another one, you can put the answer.
Yeah. The second question is, while you have touched upon it, but we've seen the COVID impact spill over into this quarter. In fact, it was more severe. So would the seasonal manpower costs that you talked about be something to be worried about in the fourth quarter as well? Could you also elaborate on the startup costs for new projects that have driven margin pressure? And basically, one tries to disaggregate this 110 basis point of gross margin dip in SCM. How much is really in the more prominent one? Is it freight cost? Is it the startup cost or the seasonal manpower cost? Or is it just spread over all these factors?
So let me try and answer that. And I think in some ways all those questions are related. So that I can try to give you one answer which covers it all. Right. So first of all, I think if you look at the concept of operating leverage, typically what happens, I think we mentioned earlier, we sign most of our solutions and warehousing-based services contracts with a minimum guaranteed volume, and there is a volume flow through which typically works through, right? And as we gain more volume, we obviously see greater leverage on earnings because that volume essentially absorbs all the operating costs, right? Or most of the costs in terms of facilities, something which is more fixed in nature. So obviously this quarter, we have been building larger facilities as we look at further growth and further volume flow through our facilities. But this quarter, obviously, volume turned out to be lesser than what we expected, and it was at the bottom end of that band. Because it was the bottom end of that band, Sumit, we obviously were not able to get the kind of returns we would typically generate. Right? While revenue was overall incrementally, I think, favorable and showed traction, it was clearly lower than what we were expecting. Right? We had set up our operations for higher levels, so revenue did come at a lower level of the band, and the way we've designed and put up many of these fulfillment centers and distribution centers was obviously take more volume throughput. Right? And therefore, we saw that impact coming in, in some measure. Right? In terms of manpower costs, I think manpower costs were really two parts to the manpower cost, and I think that will answer partially your other question as well. So part of it was the inflation in manpower costs, which we largely saw in some regions like the south. Right? As post wave 2, we didn't see migrant workforce coming back. And therefore, we had to have significant shortages, right? And that created inflation in costs. The second thing, obviously, was that volume tailed off pretty quickly. We typically, in line with our corporate philosophy, your timestamp, temporary workforce contracts for minimum durations of time. But volume tailed off much faster, and therefore, we had standard manpower capacity for periods of time. We obviously hired a large number of people during the peak, right? I mean, this year we went up to nearly 14,000 people, Sumit. So that actually ends up being fairly material, even if you end up having a 1 month lag, or even if you have several weeks of standard capacity, actually becomes quite impactful to us. Right. So as you look forward, I think we have obviously not cut down and retune some of those manpower assumptions in our business, and also work harder on productivity. So I think we will not see the the excess capacity issue which we saw last quarter. But we will obviously see inflation patterns based on how COVID pans out. I can't clearly say that we will or we won't see it completely, Sumit, given that these are all temp manpower. But what I can say is that as we stand towards the end of Jan, we have shown positive traction there during the Republic Day week, right? Both in terms of cost per person and the way capacity utilization has worked itself, right? From an overall margin perspective, I think, at your question, I think our transportation business was largely stable. I think last quarter we had mentioned that we had some flow through from a timing perspective on fuel cost increases. All that, as we mentioned in the last earnings call, has actually sorted itself out. I think transportation business is fairly stable from a margin profile perspective. Because the warehousing and solutions business, which is what is supposed to obviously is the richer part of our business, right, and what we expect to obviously drive margins, was impacted by these factors. I think you also remarked on the startup cost. I think most we do have some level of startup costs every quarter. I think a large part of the startup cost this quarter was really the cost around the optimization of the Bajaj contract, right? That's a large pan-India contract. We are doing millions of packages on an annualized basis, right? And we transitioned the entire network over the last couple of quarters, and then we have more than a quarter, between 1 and 2 quarters, that we optimize the entire network as we deploy our technology to optimize transportation lanes, optimization transportation systems, and we also drive productivity in a huge large number of warehouses and FCs across the country, right? So we had always planned to have a quarter to 2 of optimization there, and that's something which is showing up in the numbers this quarter, right? As we stand, we don't expect that window to overspill, right? It'll probably go on through parts of the fourth quarter, but we expect to basically be able to finish that optimization on plan or a little bit ahead of time. If I had to break this all up into what is the contribution of those in terms of overall kind of margins, I would say that we had probably a 60-40. 60% of it was really around the peak-related issues, both in terms of operating leverage and higher manpower costs, and 35 to 40% was because of new project startup costs, primarily being Bajaj. I hope, Sumit, that answered your question. I just tried to make it simple.
Yes, that was very comprehensive. And just to understand your P&L better, the depreciation increased quarter on quarter and year on year as well. So what was the capex in the 9-month FY22 period? And what are you spending this fiscal and next fiscal probably?
I think, Sumit, I'll ask Yogesh to answer the details, but I think what we have said earlier on as well, obviously that debt line increase includes the right to use assets. And as we kind of expand our warehousing facilities, that obviously grows in line with that. And that's why the margin enhancements on our warehousing and solutions business, which have generally delivered, is critical for us. But Yogesh, can you please chip in with the specific numbers, and then we can Sumit move on to the next person in the queue.
Sure.
Sure, Ram, and hi, Sumit. Specifically to capex per se, and our spend up to December would have been around 70 crores. I mean, if you would recall, for the year we had kind of indicated our spend to be between 80 to 85 crores range. So that kind of holds good. I mean, up to December we would have incurred capex of 70 crores this year. Last year as well, we had incurred a capex close to, 85 crores full year capex it was. And the increased depreciation obviously is a factor of last year's capex done over the year getting amortized, as well as what we would have done here. In addition to it, the depreciation amortization, as Ram explained, also covers the lease cost which gets routed through that account in the accounting structure.
That's very clear. Thank you so much.
Thank you. The next question is from the line of Dipesh Kashyap from Equirus Group. Please go ahead.
Yeah, hi sir. Thank you for taking my questions. Sir, your non-Mahindra warehousing revenues have increased 34% quarter on quarter, while the underlying space has not increased. So just wanted to understand how much of this growth is driven by the Bajaj Electrical contract, and how much is driven by the flex warehousing solution that you generally do, right, in this festive season. So, and also if you can highlight, like, what are the typical margins you will see in the Bajaj Electrical contract? Given that it's an integrated contract, the margins should be generally higher than the typical 3PL contract. Is my understanding correct?
Okay. No, strategic focus, right, on solutions. Well, the demand side was fairly positive, showed positive traction. Operationally, this was a challenging quarter in some other dimensions. Muted demand, especially in November and December in e-commerce, affected our volume flow through in many of our sites. This has impacted our operational efficiency and the leverage we typically gain in earnings from the same. From a medium-term perspective, this additional capacity should see volume recovery. The peak was also characterized by challenges in terms of manpower availability and cost challenges in several markets and manpower due to COVID and other factors. Combined with a sharp drop in volumes, there was a significant resultant additional manpower during the quarter. And while we did reduce the manpower through the quarter, this did result in additional manpower costs. We have taken effort to address this, but there was a period impact of the same. On the Bajaj account, we have now completed the transition of the account, and we now have deployed a technology-driven supply model across the entire customer base. As we had pointed out earlier, that once we complete, there will be a period of optimization of the supply chain. The way the contract, right, and the contract is structured, post-transition, we have a significant optimization which we have to do across the supply chain. And during this period, we typically have higher costs, which we saw obviously in the quarter just gone by. In addition, we also saw an impact as optimization was delayed due to multiple factors, including local disruptions and demand patterns which our customer had. But we are now focused on accelerating the same, and we expect that the optimization which was required was scheduled to take 3 to 6 months will be done on time. In addition to lower volumes from auto and farm, we did see higher volatility, and as I mentioned earlier, this resulted in lower gain sharing on some contracts. Though marginally, we had some impact of these factors. The above factors did obviously put significant resulted in significant margin pressure during the quarter due to cost escalations. We have remained focused on both short-term and medium-term actions around the same, and we do believe that from a broader term perspective, the capacity and the focus we are putting right will drive appropriate leverage for us, given that we are now seeing strong volume movement on a quarter-on-quarter basis. In addition to that, I also want to share some other operational highlights for the quarter. During the quarter, we announced, of course, the Luhari warehousing operation, which totally is 1.4 million square feet, and is India's largest warehousing facility in a single location among any 3PLs. The first 500,000 square feet is already operational, while the other 2 warehouses are now under construction. And we expect Q4 F22 and Q2 F23 delivery for each of those blocks. The new facilities will play a pivotal role in our long-term vision of creating a pan-India network of multi-client facilities, which will manage the fulfillment and distribution of our clients' operations. Over 2,500 employees and third-party associates will be employed at peak at the site. The facility, like all our newer facilities, are built to meet our broader sustainability standards, including regulations for liquid discharge management, renewable energy, waste management, right, and has significant investment in state-of-the-art construction technologies. We've been pleased to actually have the partnership with Logos to help us deliver this site. During the quarter, we were also recognized with our Great Place to Work certification. This affirmation continues to underline our investments in creating a diverse and inclusive culture at MLL, where employees can participate in creating a shared future. Our technology investments continued during the quarter. We went live in the quarter with a new platform for freight forwarding, a new warehouse management system, and upgrades to our mobility and transport management platforms. During the quarter, EDEL successfully completed 1 year of operation. During this period, we have operated now nearly 5 million clean kilometers across 14 cities in India. With a fleet which is slowly progressing to 700 vehicles in an uptime of over 90%, we are well positioned to provide customers last mile delivery solutions. We have in the past announced partnerships with Flipkart and Amazon to help work with them on expanding EV-based services, and we continue to expand those relationships. In November, we also announced the acquisition of Meru by MLL, a collection of 4 companies. With this mission, we will add airport ride-handling and on-call services to our enterprise mobility services offerings. Meru and Allied's combined expertise will allow us to offer better B2B and B2C services, and gain better share of wallet with our enterprise customers, while delivering on a broader promise of safety, customer satisfaction, and long-term sustainability. As part of that transaction, we also will be adding 250 EVs to our fleet. We expect and we are continuing to obviously see a significant recovery in the airport business across the board, but we also expect synergies to come in as we integrate the enterprise end of both the businesses, which will drive better asset utilization, greater supplier cost leverage, and improve cost management within our business. Our integration teams will launch those synergy initiatives post-closing of the transaction. Now, let me share the financial performance of the quarter ended 31st December 2021. Revenue for Q3 2022, sorry. Revenue for Q3 FY22 increased by 7% to 1,118 crores as compared to the same quarter in the last year. Gross margin for Q3 FY22 stood at 8.9% compared to 9.9% in the prior year's corresponding quarter. EBITDA for the quarter stood at rupees 50 crores compared to 55 crores last year. And as a result of that, PBT was down 71% from rupees 25 crores to rupees 7 crores, and PAT was down by 72% from rupees 5 crores to rupees 5 crores in the quarter. PAT margin stood at 0.5%. Proportion of revenue from the Mahindra Group now comprised 44% in Q3 FY22 compared to 48% last year. If I look at segment performance, revenue from the supply chain management segment increased by 6% to rupees 1,075 crores. The enterprise mobility segment underlined the uptick in revenues and growth there. Overall revenue there was up 16% to rupees 43 crores. Revenue from supply chain management contributed 96%, and the mobility business comprised 4% of our total revenues. Our non-M&M SCM business grew from 501 crores to 590 crores, an overall growth of 18%. Underlying that, of course, we did have a decline in the auto business, but offset by a 24% overall growth in e-commerce, consumer, and other businesses. Our warehousing and value-added services for the non-M&M SCM business grew from rupees 164 crores in Q3 FY21 to rupees 225 crores in the current quarter, registering a growth of 37%. Share of warehousing and value-added services in non-M&M SCM has reached 38% compared to 33% in the same quarter last year. Obviously, we do recognize that while our revenue performance, as I said, we feel has been positive. We continue to see traction there, and the revenue profile also lines up to our broader solutions. During the quarter, we obviously did see margin impacts due to the factors we outlined earlier. As we reposition the core 3PL business towards integrated solutions, we have seen lower volumes in this quarter than what we had set up the quarter for, and lower flow-through impacted leverage and obviously compounded higher manpower costs. In addition, the Bajaj account had an impact as we have a time lag between transition and optimization, which we had discussed earlier. These collectively are the primary reasons for the margin pressure which we saw this quarter in warehousing and solutions. Our transportation margins have remained consistent, which includes the business from M&M. Overall, across all verticals, we continue to witness strong revenue traction, a continuing story now for the last few quarters. We remain upbeat on the new opportunities that we have embarked on with some of the recent client acquisitions, and obviously are very focused on driving the efficiency in our operations to be able to drive earnings back to our historical trend line. With that, I thank you for your attention and will open up the floor to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kishore from Axis Capital. Please go ahead.
Believe integrated solutions will bring is around, around stickiness and size, right? And that should actually give us leverage from an overhead perspective, right? So the way we look at a business is we having gross margins which are, I would leave this quarter aside, right? Just leaving this quarter aside, but broadly we'd expect that the margin profile would be slightly on solutions would be slightly better than what we have done in the past, and the volume growth which we get through that, should be able to actually start leveling off on our overheads. I think even this quarter, and Yogesh can say specifically, but even this quarter, I think our overheads, you've seen our overheads only grown by 3%, right, on that revenue and volume growth, right, and we continue, and it's now probably at 4.6% or so of sales. So as that volume growth comes in, we'll be able to accelerate the leverage on that line as well.
Right.
From modeling perspective, Mukesh, probably you and Yogesh can get back to you and have a specific conversation around.
Sure. I will get in touch with separately. Again, just looking at say the last quarter and this quarter. Last quarter we had seen an impact of fuel prices, and that would have impacted our transport. And I'm assuming this quarter we would have got the pass-throughs for that, and hence the transportation margins would have gone up because diesel prices actually came off in November. So in a sense, the warehousing margins are actually much lower because the transportation margins would have been up QOQ. And probably this should correct, is what we are saying, after the optimization phase, and we should see a significant increase in warehousing margins.
So what I would say is, Mukesh, I think I said in last earnings call as well that we have finished passing through all the fuel increases, right? So that was not the problem. Obviously, transportation volume is kind of flattish, and the Mahindra business is down compared to last year, right? And that's a large part of our transportation volumes as well. So at a gross level, I don't know exactly how it has, I think we'll have to get back to the exact dollar values for that. But broadly, as I've said earlier in the call as well, the transportation margin profile was pretty stable, and in line with the past. And that's why we called out specifically that most of the challenges or the erosion or the pressure we have seen in this quarter has actually been on our warehousing and solutions business.
Sure. Right. Thank you so much for this. I'll get back to you. Thanks.
Thank you. Participants are requested to restrict their questions to 2 per participant. The next question is from the line of Shyam Sundar Sriram from Sundaram Mutual Fund. Please go ahead.
Hi, Shyam.
Hi, sir. Good evening. Thanks for this opportunity, sir. You did mention that the higher capacity build up in warehousing, expecting volumes to come through was one major factor for the margin drop. What steps can we take internally to plan better so that these incidents don't reoccur? That's my first point. Secondly, you did mention the flex solutions are on similar margins as the standard integrated solution, standard warehousing solution contract. Now, I'm very surprised given the short-term nature and the enormous stress that it puts on your system. Shouldn't this business be a higher margin business? Or is it, just if you have to think about it, is it even worth doing this business with so much of variability and the stress that it brings upon the system per se? This is my first question. Secondly, are there any further startup costs in this first half calendar 22 because this was a 45 bits kind of an impact per se at the gross margin level? Are there any further similar startup costs expected in the first half of the calendar 22? Thanks. These are my questions.
So I'd say Yeah. So I think let me answer the second part first. I think, as I said, Shyam, earlier also, we carry a little bit of startup costs every quarter, right? That's kind of normal to our business. This quarter, we've seen the higher impact of the Bajaj cost, and that network optimization will have a overhang through the fourth quarter. But as we plan right now, we don't expect it to carry into the next FY. Okay. Right. And that's given the scale of the contract, a 3 to 4 month pan-India network. We are doing, 800 to 1,000 trips every day across 11 facilities across the country, 13 facilities actually across the country. So, and delivering to more than 700 delivery points. It's a large optimization. But that should get done through, as I said, the fourth quarter of this year. Apart from that, I don't expect anything really to come out. There is a learning curve, obviously, on scale as well. So I think next time, as we do larger and projects, more projects of the scale of these, I think we'll obviously have a learning curve on getting better at the optimization as well, right, as more volume comes through. In terms of the flex contracts and the other question you had around optimization. So obviously, I think, as you know, we've been expanding. You have to take a call on how you build, warehousing infrastructure and warehousing capacity, right? You can't. And so it is a shift function. It's a step-up function. It's not a linear function, right? So that's kind of a bit of the broader, and therefore the horizon of planning has to be a little bit longer, right? We can't add. Shyam, we can't add 20,000 square feet every month, right? That's also suboptimal in a different way. It's probably low risk, but probably also creates low return from a long-term perspective. What we have been doing to optimize it, obviously, is if you look at our facilities, which are and our capacity, which is more flow storage based, we have been trying to divert that across some of the newer clients, and that's why, and been trying to kind of get better, square feet utilization in terms of revenue yield. And we are hoping to consolidate. We started that work actually already, and I think hopefully through this quarter we will see more acceleration of that with some of the newer businesses which are being picked up. The second part there obviously has been to retune our manpower productivity and recruitment assumptions, and that's something which there will be some volatility which probably will continue basically the individual geographies, but we broadly think that at least we are getting that under control, and the Jan peak thus far has been a good, has kind of shown results of the work we have done. Right. So I think the capacity issue, very honestly, I think we feel confident about the fact that it'll kind of play itself out, Shyam, because as I said earlier on, we have to take positions. We can't just build facilities every month, right? And as we build larger facilities, there are long-term productivity and OpEx benefits there, which will start showing up in our margins as well, right? As far as the flex question you had, Shyam, I think flex is a combination of different things, right? There are pure flexes where you're going to middle of nowhere and actually building a short-term flex solution, and those generally do carry a higher margin profile. And then there are large flexes which actually often are kind of attached to an existing node which we operate ourselves, right? So, for example, in Calcutta this year, we did a 3 lakh square feet flex for one of our clients, right? Now that's next to another facility which we operate for the same customer, right? And therefore, the stress which you spoke about is a little bit different, right? The pricing is a function of multiple factors, and I would say the flex model is also becoming more mature. Shyam, I think both in terms of cost management and, of course, in terms of the competitive functionality there also is increasing, right? So we do get, I think, margins. Typically, if we don't have any disruptive factors, we do get margins slightly higher than our typical warehousing business, but it's not a gold rush anymore. I hope that I don't know if that kind of answered your question, but
Yeah. I got your point, Ram. But the only question I'm still wondering our revenues have grown 10% sequentially. We have done very well on that. But nevertheless, our earnings on this higher revenue has been lower than what we did last quarter, right? Which means we are losing money by putting up these flex solutions that have lot of variability. Of course, there is a startup cost element also which is there. but that will ease out. I'm just wondering whether is it worth at the end of the day to have these variable businesses. That was my limited point.
So sure, Shyam. And I think the capacity issues exclude the flex point. So I would say that your flex is not counted as a capacity expansion I talk about. Okay. And the manpower problem was reasonably secular. Typically, you are hiring in many of these facilities, they are manpower intensive to some extent. So you normally have 35-40% cost of manpower, even on a business as usual basis, Shyam. If not in some products, even offerings even higher. So when you see a sharp escalation, let me just obviously comment on both of those, right? So first of all, I think when you look at our warehousing has not exactly been flat quarter on quarter. Typically what happens is we take the end of quarter warehousing stamp, the date stamp to the end of the quarter. And therefore, obviously, all the warehousing came through by September 30th, but it was not necessarily operational fully during July to September.
Got it.
So obviously that's something, it isn't all kind of sort of kill switch. So where effective warehousing, utilized warehousing space did go up during the quarter because of the time stamping of that. Now, to your broader question, in that 225 crores, jump, which was a 37% jump, how much of that was because of other normal BAU business, not just Bajaj, business as usual volume, versus what was it specifically because of the flex accounts? I would say probably 70-30. Right, 70% of that growth has been our underlying volume growth from a BAU perspective, and 30% of it would have probably 25 odd % of it would have been because of flex, right? And obviously we were hoping it could have been even higher, to be honest, because of the commentary I made. As you have seen the commentary I made earlier, volumes did come in short of what we had planned for. Right. So I hope that answers the question. I think Yogesh, anything you would like to add there?
No, that's correct. It's about that 30-70 split.
Got it. And sir, typical margin profile for this flex solution that you provide, and also about the Bajaj electrical contracts.
Sure. I'm sorry I missed that question. So I think flex is a function of multiple factors, but obviously our margins, if the volumes do come in as we plan, the margins tend to be in line with our general warehousing contracts. Right. What we generally do is on the back of that flex, we normally also end up picking up your transportation business, and so it kind of the integrated benefit does come in. On the Bajaj account, I think what we have, your Bajaj account, like all our integrated solutions businesses, is a blend of warehousing and transportation, right? At peak, we expect to earn margins which are in line or slightly north of our average profiles, right? Obviously, that that is a curve, right? So the way that kind of an account, or even for really larger projects happen, is you start off and then you have a dip, right? And you have a carrying cost till you optimize the supply chain, and then you actually start margins kicking in. Peak margins obviously tend to be higher than the average, right? And therefore, at that point, we should see higher than typical warehousing and solutions margins, right?
Got it. Yeah. So second question is, just wanted to understand your thought process on the acquisition strategy. Recently, you acquired Meru Cabs from your group company, right? So now going forward, like, will we wait for 1 year or so, or we are still looking at acquisitions? And what are capabilities you want to add going forward when you look at an acquisition pipeline? If you can just touch that.
Oh, great question. So first thing I would say is that our acquisition strategy has two parts. First of all, I think we don't really look at acquiring order books or revenue books, right? I think what's really important for us is to acquire capability. And for us, the capability part of it largely is around technology capital and people capital, right? So that's also one overarching thing, which I've said this before as well, but I just reiterate it for purposes of reaffirmation. The second part is our inorganic strategy from a cap table perspective is not tuned towards any specific, is not biased towards mobility or towards supply chain. We continue to look at opportunities in both of them, right? Actively, given the strategy of each of those segments, right? On the supply chain side, I think where we are where we are looking at, how accelerating through inorganics is on, I think, really three parts. Obviously, we have talked about freight forwarding earlier. It's a business which, at the services end, it's a business which we feel positive about. And it's something which we are looking at, we continue to look at the right opportunity there. The second one is around last mile delivery expansion. That's an area where, as we see more traction from our clients around integrated fulfillment, we have largely been a first mile and mid mile company on fulfillment logistics. Now, we continue to look at opportunities in last mile if we believe that they bring the right, combination of, of people capital, tech capital, and financial prudence, right, and financial management, which, from an earnings quality perspective. The third area, of course, is technology, right? We have continued to make investments in technology. A lot of that has been in our, as I've said earlier, a cloud-based suite of integrated solutions for different service lines. But we continue to look at possibilities there, either for partnerships, right, or acquisitions. We have largely been using a partnership model till now. Right, and as far as the mobility side is concerned, as I think we are keen on primarily focusing on the enterprise segment, and the core strategy for the mobility business remains about doing two things: expanding services to enterprise customers so we can gain more share of wallet, and leveraging that share of wallet to drive supply optimization at the back end, both in terms of ICE and EVs. Right, so the Meru acquisition was really a fit in that sense. 35 to 40% of the business is purely enterprise transport management services, which is what Allied does. So that's a straight synergy fit. And then it also provides other services like on-call, etc., which allows us to get a higher share of wallet with our enterprise customers. We believe there are some strong opportunities from a supply synergy perspective. Those will probably be more visible once the market recovers fully. But intrinsically, we believe there are strong opportunities to drive tech-driven supply chain optimization, where we can use the same vehicles, let's say, for multiple services, and therefore utilize it for more kilometers in a month, and therefore drive better margin realization.
So thank you and all the best. Thank you. Yeah.
Thank you. The next question is from the line of Mukesh Saraf from Spark Capital. Please go ahead.
Hi, Mukesh.
Good evening, and hi, Ram. Just wanted to, one of the comments you just made was that on the integrated business, the margins would probably be similar to the company average or probably slightly north of that. So just trying to understand that with your targets of maybe 10,000 crore revenue in, say, FY26, and probably a good portion of the business coming from new integrated solution contracts, what kind of margins, is that average, is the company level margins that we're looking at, are we looking at a similar 4.5-5% kind of margins? Because if these new contracts come in only at these margin levers that we have.
So Mukesh, I'm trying to make it as specific an answer. But I think if you look at it, if you look at the broader growth plan for the company, I think as you said earlier, three broad parts. I will skip the mobility piece. That's part A. Part C, actually. Part A has been the core 3PL business to reposition ourselves more as an integrated solutions player, right? And part B has been to grow some of these service lines where we historically had low share of business: freight forwarding, the B2B express, last mile delivery, and probably kind of create this electric vehicle category in some ways, right? So these are the A, B, and C parts of that kind of roadmap to 10,000 crores, right? Now, if you look at, I won't talk much about mobility, because I think your question is driven by supply chain, right? On the services side, I think on the express side and the freight forwarding side, I think we expect to basically maintain or sustain the margin levels which we are at right now, right? And I think we've fairly been able to moderate, right, and ensure that we are having reasonably good gross margins in forwarding as well, right? And the express business, while we are funding it, will mature to a moderate industry level margin profile, right? The last mile delivery business, as you know, Mukesh, we said earlier, we are cautious about growing there because we have specific margin targets and capability expectations there, right? Now, on the integrated solution piece, which is where I think, which is probably going to be 2/3 of that whole pie, right, over a period of time. But I think what we've said historically is two things. One is that and I think we're still on the same page. One, I think, is that at the gross margin level, net of the AS 116 impact, we expect the margin of solutions to be accretive to the gross margin, right? And today I can say that on the smaller and mid-sized solutions we have done over the last 18 months, whether it's been pharma, whether it's been durables, whether it's been appliances, I think post the correction period which we have, or the optimization period, several of those projects are delivering that. Okay. Now, so that's one lever of benefit, just purely at a gross margin level. The other benefit, which we obviously there, now it does have and tail through impact. So I would say this quarter for sure, flex was not the problem for us now. I hope that probably is a good way. If that's what I would summarize it. I don't think flex basically had an overhang on our earnings.
Sure. So, sorry, just one last question, if I may please. Given that there is a sharp inflation in manpower, I mean, not only for us, across all industries, we are seeing a much higher inflation in terms of the manpower cost. Are there any elements in our contracts with customers that allows us some kind of a pass-through for this slightly higher than expected manpower cost?
Yeah, I think, the contracts are generally done in multiple ways, Shyam. I think generally your contracts which are more long term, like Bajaj or some of the other accounts which we do, they normally either carry an index based on minimum wages and so on. Right. Then there are contracts where the volumes are given every year, right, which are manpower driven, and there, it's really been it's where we do discuss what the cost impact is. There are some thresholds which they cross, and obviously we have a chance to go back to the customer. But there are bands within which we have to manage the performance ourselves, right? And this year I think and this year was not, and that's why it didn't affect us on flex so much, Shyam, because on flex we actually have a much more near-term window to that cost structure, right? But on our long-term contracts, on our longer-term operations, when the peaks come in and let's say they suddenly result in a spike in cost, it just doesn't affect your flex. Actually, flex probably is better because you're contracted in the short term. It's your base business that actually you see the tail through effect.
Understood. Got it. Thank you very much. And
if you take Bangalore as a location, then suddenly, you've got 3,000, 4,000 people in existing sites. In the peak, actually the small flex site doesn't cause the problem. The inflation across the board causes it.
Understood. Got it.
Thank you. The next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Hey, Aditya.
Hi, Ram. Hi, Yogesh. I had a few questions from my side, which I want to take your perspective on. Ram, the first one relates to the warehousing business of yours. Now, I'm just trying to kind of get a sense that when you say that volumes were not up to the mark, was it more of an issue of demand being weaker at an overall level, or was it an issue of competition getting in more and more?
Okay. I think if you want to skip all the questions and we try and answer them together, does that work for you?
Sure. Sure, that works. See, the basis of this question, so the other related question was that, somewhere you mentioned that your new contracted capacities are all doing fine. They are fairly well utilized. And still, we are saying that our utilization levels dipped because we had planned for higher volumes and we didn't get those volumes. Does that suggest that the older warehouses saw some customers not turning up? And just kind of relating it to the competition issue again.
Let me just explain this, right? So typically, I'll try and do this conceptually. When we kind of contract out the facility, let's say, which is X square feet, 1 lakh square feet, for example, we contract out that capacity. That capacity is contracted out through the year for a certain volume and for some parts of the year for much higher volume. Okay? Right? Now, we don't have any white space, or we have very marginal white space in terms of contracting itself. Right? Our facilities are all contracted out. However, what happens is that the contracts basically are built around a certain volume. Now, in that volume band, there is a minimum guaranteed volume, Aditya, which happens, right? And then above, that's a minimum guaranteed volume which the customer gives. And then, of course, you have a higher band in terms of what is the capacity what is your peak capacity, right? Or what ideally you make really great margins at. So this year, the problem was not that we lost sites, right? I mean, all our sites were contracted out. The problem was that if we expected, let's say, 100 units to come, it was actually like 85, right? So if we expected to, I mean, if you compare it to a plant, for example, it's not like a plant was not utilized. But the thing was, instead of making 100 units of a product, it actually made 85. Right, and the challenge for us was that we did see our peakiest days were still 100, right? But then typically the peakiest days tend to last for a longer period of time. This time there's a sharp tail off in terms of volume. In fact, in December, some of our sites are actually below minimum guaranteed volume, which of course our clients paid for the minimum guaranteed volume. But so that was the factor which was playing around. It's not like any of our sites basically, we didn't have a competitive situation. Let's say our volume went off to somebody else, or we lost a site, or our sites are not actually contacted. What we have stated in terms of what I've said in the past is all that when we have talked about the warehouse contracting, we have said yes, all our facilities are contracted now. We don't have white space in terms of uncontracted warehousing. But obviously, you expect the warehouses to have a certain flow through in terms of volume. And this year, and we had obviously we've added capacity in the assumption that the volume build up will happen, right? And I think it will. I think this is a time of day or time of kind of season factor. Secular growth will bring in the volume to our facilities, right? At the higher end of that contracted band. But this year, unfortunately, we are much closer to the lower end of the contracted band in many sites. And the higher manpower cost obviously didn't change the cost basis of those facilities.
Got that. Ram, the second question that I want to kind of ask was that it's related to the question asked earlier. There is an element of inflation in manpower cost on additional manpower and maybe on existing manpower as well. And our contracts are structured in a manner wherein we cannot pass them through fully. Should this be treated as an overhang on margins in incremental quarters or let's say even incremental years, because these are long-term contracts that we are signed from a warehousing perspective?
No, I think, what I would say, Aditya, there are multiple factors here. We control productivity. And total manpower cost is a function of volume of manpower and cost per person, right? So one of our competencies, Aditya, is actually driving better productivity. Right, that's kind of what our solution design and our dexterity work and our process capabilities always are, and that's what we do in most of our sites. Yeah, even this year, I think the manpower inflation was specific to some locations, right? I think I mentioned earlier in my comments, we did see a specifically larger problem in the south, for example, which is where we do have thresholds which are contracted out as well. But in the south, we saw in a couple of locations where we saw a large spike. Those are big geographical locations for us, and that was very topical to those areas. We didn't necessarily see it in Delhi. We didn't see it in Ahmedabad. We didn't see it even in Bhiwandi or Pune, right? But we obviously have a fair amount of capacity in the south, so that obviously did impact us. But we still believe that, as I said, we have even coming into right now, we have retuned our work on capacity improvements, and obviously we probably planned for a larger volume, and we could have, and you can plan differently as well. We planned for a higher flow through this year because, by most expectations, I think the peak was expected to be higher than what we thought it would.
Got that, Ram. That clarifies. Last question from my side. You've been talking about adding capabilities to the bouquet of what Mahindra Logistics offers since the time that you came at the helm. Would you think that exercise is largely completed, and maybe last mile is the only part that the company would think through adding to the capability set, or do you think a lot more work still needs to be done in terms of becoming more likable to your customers?
Sure. So I'll answer that. It's a simple answer because I obviously have to talk about this a lot often to other stakeholders as well. So I think 2 years ago, what we said is as we reposition the business towards to the future, we have to add capabilities in three things. Expanding service lines, driving more ability to create custom industry solutions which are more integrated, and the third one is technology capabilities, right? I think from a service line perspective, I think we have established baselines now. We were doing 7 or 8 services 2 years ago. We've now expanded the offerings inside warehousing. We offered several new service types, and on transportation, several others, on distribution, on freight forwarding, etc., have made progress. So I would say there probably the larger challenge right now is what you pointed out there, which is last mile delivery. Okay. On the technology piece, I think it's a continuous journey. I've said this earlier, we are never done with technology, but we did put out an 18-month roadmap to get a fundamental architecture on all these service lines together, which we could integrate efficiently. I think that one is probably 85 to 90% done out of it. Okay, so we should really not see a significant bump up going forward from a tech investment. There will be probably a linear expansion on tech, definitely, but but beyond where we have, I don't see a significant bump up on tech. We may make some investments in in blockchain, a bit more in AI, some on automation, but I think those will be par for the course kind of stuff. On the solution design work, I think we are doing some transformation work internally with the help of external consulting, and we probably have another 6 to 8, 9 months of that work, to go there, because that's changing process, people, investing in domain knowledge, and then integrating obviously operations and tech into that offering, into those solutions as well. So I would say, just to recap, services almost there, tech 80 to 90 to 75 to 80% there, and solutions probably halfway there.
Got that, sir. Those are questions. It gives me a sense how to think of the company. I'll come back with more questions at the end. Thank you.
Thank you. The next question is from the line of Pranay Roop Chatterjee from Burman Capital. Please go ahead.
Good evening, Ram, Yogesh, and everyone present. Let me know if I'm audible clearly.
Hey, Pranay, can hear you.
Great. Thanks, Ram, for all the details. I had 3 quick questions. Firstly, you mentioned that about 60% of the margin drop this quarter could be attributable to your excess capacity related to your manpower and volume. Now the question pertains to Q4, more on Q4. Given the impact of Omicron, right, and how do you see volumes, and is this overcapacity issue behind us, or should we expect some impact of this in Q4 as well? Secondly, on Meru Cabs, right? When do we expect the consolidation to complete in terms of your financials? And given that Meru had 18 crore loss in FY20 and about 30 crore loss in FY21, I understand there would be certain rationalizations and the loss would minimize, but could we still expect like a 5 to 10 crore pressure on your bottom line post consolidation? And lastly, a quick question for Yogesh. There's this item called cost of materials consumed, ANL, which came at about 5 crores this quarter. Just wanted to get a sense on what this item entails.
Yogesh, do you want to go first, and then I'll kind of cap it up on Q4 and
I'm just pulling out the financials what Pranay is referring to, so just I'll do that.
Well, I could then. Let me go first. So I think, so I would say that most of on that additional capacity and the manpower cost piece, I think Pranay, Omicron obviously is resulting in fluctuating volumes. So we are not really seeing volume pick up, and there will be some impact of the flow through, I think, in our facilities through this quarter. But what we have done, I think, on the people side is I think we've got that under control, right? So that's been something which we moved quickly on. We do have productivity and process standards internally. So I remarked earlier as well, we just kind of going through the Jan peak, as you've seen, as you generally know, I think most e-com customers and others actually have a peak in Jan, and obviously things like fans and coolers also start moving at a period. And that's something which obviously we have been able to mitigate the impact we saw in last quarter on that. Okay, so I know that. So the manpower side is taken care of. The flow through on volume might still carry some softness. On the Meru piece, yes, I think you raised a great question, right? And I think you've seen the historical, all of you have seen the historical results of Meru. Now what we know the Meru's existing management has already done has been obviously been trying to kind of manage and optimize costs further, right? And what we believe is that as we go in, we expect the three big waves of synergy. Pranay. The first one is substantial synergy from an overhead management perspective, right? As the volumes have shrunk, we think there's a lot of, all of us have taken cost out, but still overhead typically in the mobility business in terms of tech, sales, marketing, site management, etc., remains of reasonable volume. Now we think that's a straight, just do it kind of synergy, which we expect to come through, right? The second piece really is around the fleet optimization. As we, typically both companies are largely asset light, right? But both are businesses. But clearly we expect that our supplier leverage will go up significantly, right? We will be able to use the same cars for higher hours and higher miles, and therefore, the marginal pricing is obviously, the price of your last slab with your vendor is always lower than the price of your first slab, right? And that's a synergy which we have evaluated and assessed, and we have fairly good line of sight to that. The third synergy is actually around demand optimization. So there, I think, and what we mean by that is two things. One is having a wider bouquet of services allows us to go and get better share of wallet, right? So if you are, if you are General Electric for G, for example, and we are doing, we are doing ETMS for you. We know that you are also doing on-call. You also have airport kind of pickups and drops, right? So our ability to cross-sell actually is something which should pull in better revenue for, especially for the Meru business. The second part is going to be that better supply obviously means that you will have better availability, right? So we believe that especially for the airport and the on-call business, one big lever will be that we think our supply capability will help Meru have lesser incomplete trips, right? Which is, for example, when you walk out of the Bombay airport, you order a Meru cab and it's not available, right? So that kind of scenario might not happen because we'll bring our supply capability. Now put those three together, I think we expect to significantly have better earnings in the business than probably what Meru has had in the past, right? But that said, I think there will be some negative impact, marginal impact, right, in the first financial year, given the current demand environment. I'm not in a position right now to fully quantify that, but it should be, of course, of a much more managed order than what you may deduce from historical financial statements.
Got it. And when can we expect this consolidation to complete? Is it Q4 or is it going to flow into next year?
Yeah, we are working through the timing of it, Pranay. So I think hopefully somewhere between the latter half of this quarter or early part of next quarter, we should expect it to get through. I think from a governance perspective, I do believe, and Yogesh, you should add, but you can add, but we have already informed, updated the stock exchanges also about the deferral in closing.
That's correct. So at present, we are looking at to wrap it up. The last we had looked at the license within end of February. If there's any change, we will again obviously intimate. But right now, that's the timeline we are expecting.
Got it. Ram, quick follow-up regarding our margins. I get your point. Still, if you try to look in terms of numbers, can we expect it to go back somewhere near Q2 levels, or would say Omicron impact keep it somewhere in between?
Our aspiration, of course, is to try and take it back there. We're working obviously pretty hard on that right now. Right. As I said, there are two, three big impacts. I think the Bajaj optimization costs and the new product, which is the largest part of the startup cost, I think that will have an overhang for net through Q4.
Mm-hmm.
Okay. I think from a demand perspective, we do believe that we will optimize, while volume flow through in our facilities might be a bit lesser, we will optimize other cost levers to basically offset that, right? And I think the manpower cost piece is already under control. So we don't think that the Q3 issues we had in our BAU business will continue to Pranay for most this quarter, and we don't think Omicron will have an impact on that. right? So because we run a lot of high volume nodes, right, for our customers in their network. And we'll also see seasonal upticks in some areas, right? So for example, on things like fans, independent of Omicron, we will see some seasonal patterns of strength in Q4 as well.
Right. Thanks. And the last piece, I think, Yogesh, if you could.
Yeah. So on that piece, I mean, we have, so as part of the value-added services which we offer in our supply chain, Pranay, I mean, there is things which we do in terms of component assemblies at our sites. Things like what we used to do in terms of tire and wheel, in terms of completing a product, or in farm equipment, certain components also we do. So this is the cost of material consumed in delivering those services. From a breakup of accounting line items, I mean, since the service is now a defined service within that, I mean, that's kind of called out separately. But this is a cost of material consumed in delivering the value-added services within supply chain.
Understood. Okay, great. Thank you, Ram. Thank you, Yogesh.
Thank you. The next question is from the line of Alok Deshpande from Edelweiss Financial Services. Please go ahead.
Hello, Ram. Hello, Yogesh. Am I audible?
Yes, Alok. Hi.
Yeah. Hi. Two questions from my side. First question is on margins. I just wanted to sort of understand the margin mix better across transportation and warehousing, because if I were to compare the margin profile for the company, which was roughly 8-10 quarters back, and I'm talking about somewhere around mid FY20, when this was before COVID, we were at about 4.5, 4.7. Now, given the fact that warehousing has become nearly 25% of the overall revenue from 15% 2 years back, despite the startup cost of these new projects, I'm just not able to sort of put this together that why should the margins be lower than the levels that we were at nearly 8-10 quarters back, when the warehousing piece was only 15% of the total. That is question number one. And my question number two is, Ram, you spoke also about the margin, the volume shortfall this quarter, where the volumes were at the lower end. Now, in these kind of contracts, wouldn't the fact that these are variable volume contract or variable price contracts, wouldn't that sort of better pricing make up for the fact that if in a quarter there is lower volumes, still the margins are quite decent? I just wanted to understand this conceptually better.
Sure. So let me try and answer the second one first, and then I think we'll dial back and I'll let Yogesh pull out some of the data, which I'm sure he may need to pull out as well to answer the first part. Right. But so the second part, so if you really look at the way the contract is done, we do. So let's assume our site is contracted for 100 units a month. We will only carry a minimum guaranteed volume of 70, right? 75, right? Now, typically what happens is that while we have a minimum guaranteed volume of 75, what will happen is that we will actually, based on the customer forecast, be sizing the two things happen. We size the facility for overflow, right? And the second thing which is there is, we will also actually recruit manpower, right, and plan shifts, etc., basis a certain volume. So when I said that the volume flow through has been lesser this month, I mean, think about it. If you're more conversant in manufacturing, think about it in that sense, right? Saying that we essentially planned, let's say, 90-95 ka volume, and we essentially lined up all our resources for that 90-95. The volume came in at 75 or 80, right? Now, probably we obviously have, we've been aggressively trying to grow the business, and we've kind of gone after volume growth, right? And putting infrastructure and resources to do that, right? So what has therefore happened is that you have a certain amount of resources which are standard, right? Some of it like your scheduled hours, etc., or operating electricity, etc., you can turn off quickly. Some like your manpower, you actually do timestamp the contract with your vendors for some period of time, right? So if you are contracted them, let's say on a monthly basis, the volume doesn't end up for the month, then you obviously end up with standard manpower, which is a point I made earlier, right? So that's what played out, right? So now obviously, if you are based on your relationship and your confidence in the planning work you do your customers, you size the business for a certain level, right? Which is kind of what we did this year, and that's what was the capacity flow through problem we had. If the volume had come at 90-95, we would have seen all those resources being used fully, right? Now, the second part, which is what I already said earlier, then that 85-90 people, let's say the cost was 30 rupees an hour for them. Because of some of this inflation, it might have become 32, 35 rupees in specific geographies. So your cost basis increased in some geographies, and then you obviously saw lesser utilization of these resources than what you had planned for. The good thing is that we, as I said, because these are all manageable in some windows of time, we have obviously taken actions on most of that already.
Sure. And the first question on the margins?
Yeah, so Yogesh, do you want to throw some color on that? I don't have my files with me right now, Yogesh, so you may just need to pull out some of it, if you can.
Sure, Ram. So look, from margin perspective, I mean, is it okay if I just walk you through separately? I mean, I'm just cognizant of, Ram, your current time also as well right now at 5:17.
Sure, no worries. Yogesh, I'll connect with you later, no problem. Thanks.
Do we move to the next question? Thank you. The next question is from the line of Prateek Kumar from Antique Stock Broking. Please go ahead.
Hello, good evening, sir, and thanks for the opportunity. My first question is, would you have FY21 numbers for Meru top line PAT, and how has they panned out in FY22?
So I don't have Prateek, I don't have the exact numbers. I think there will be filings, etc., which will cover that. And obviously, I think if you reach out to us separately, we can answer that question more specifically. And unless Yogesh, you have the numbers handy. But I would say that compared to F22, F21, F22 directionally obviously has seen growth for them, Prateek. Right? That your Meru has largely three parts of the business. The first part is the ETMS business, which is 30 or 35% of revenue, which is similar to what we do in Allied. So that business has not seen a lot of growth. It's kind of, I think, being fairly neutral. But the airport business, which had come down a lot because of the pandemic, as before Omicron at least, as the volume had started coming back, they had actually started showing some positive momentum on the airport side. So overall, I think revenue was trending positively, directionally for the business. Right? In terms of cost, I think there are multiple factors, but we know that they have also been working on cost optimization. I don't have the exact numbers with you, Prateek, unfortunately, for F21, but I think if you reach out to us separately, we can definitely cover that.
Sure, sir. The second question on over past 2 quarters, when you compare Q1 to Q3, our warehousing space has sort of remained stable. In fact, past 4 quarters, warehousing space has remained stable or sort of declined because of, I think, some reasons which you highlighted last quarter. But when we add depreciation plus interest, which has a component of ROU assets, that number has grown 8 crores over past 2 quarters. I'm just adding depreciation and other expense simply. So why has that happened if we have not added any space? Because that is actually weighing significantly, because your PBT in third quarter is 7 crore and that incremental 8 crore is sort of having significant impact on your PAT.
So Prateek, what I say first of all is I think that is actually just in our view. Let me kind of say this first. So your first point around warehousing space, I think you will see slide 12, and we added this last quarter, Prateek. I think in response to your question, you had only asked in the first quarter, and we started breaking down between warehousing and stockyards. Stockyards are very, very low value. They're high space, but they're actually low value and low cost as well. So what you will see generally, I think, if you look at FY21, we ended with 17.5 million. And you could say they ended 18.8 million in Q3 FY22. So you're probably reasonably logical, which is only gone from 17.5 to 18.8. But if you actually break that down, pure warehousing and stores and line has gone from 11 million to 15 million. Right? So that's been a 35 to 40% growth in terms of the space. Right? In terms of pure warehousing, which is where the depreciation actually adds up, Pratik. Right? So I think that's the curve. And I think you had raised this question. So we started giving this breakup last quarter, right, Yogesh, to help you people actually in response to your questions, to help you understand underlying factors. Okay. Now, so that's one. The second thing I would say is that debt itself carries two parts. It carries a straightforward rental cost, which is really a restatement, right? Our gross margin should actually should basically compensate for that, right? And the second thing is there is an AS 116 timing impact because that timing impact was AS 116 front-ends the charge. I think Yogesh had explained last quarter also that we saw 3 to 4 crore impact in the quarter because of that. And this quarter also we have seen something similar, I think. Right? Yogesh can probably elaborate on that a bit more. But it is not, I think, accurate to while the overall number might have not increased. I think at a category level and specific to what drives depth, I think there's been a fairly significant increase in capacity.
Sure. Thank you, sir. That helps.
Yeah, so Pratik, in our presentation this time, we have split those two line items also. So you would see that the split which is coming in because of this warehouse space rental cost, which is 116, and the normal depreciation as well. So that will, kind of do that. And another thing is obviously the more costlier space in terms of value added or more standard warehousing which has got added in. There is another element, the third element. I think one more thing I'll add on what Ram said, which is certain space which was towards end of quarter 4 of last year, which was customer owned space we used to work out of, which kind of translated to our own space. So which also meant that we will not, from a cost perspective, the space count remains same, but the rentals would have come in now.
Sure. Thank you, sir. That helps.
Thank you. In interest of time, this was the last question. I hand the conference over to management for closing comments.
Okay. Thank you all for joining us today. I hope we've been able to answer all your questions satisfactorily. If there are any other queries or questions, you may reach out to us, right, and our investor relations team, right, at MLL and SG, our investor relations advisors. Thank you once again for your interest in the company, and thank you for taking the time to join the call today.
Thank you. On behalf of Mahindra Logistics Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.